Okay, well, we're with SVA. It's a CPA firm here locally. We also have a branch in Madison and Colorado Springs, locally owned. And, if you have any questions, we want this to be interactive, so feel free to jump in, raise your hand. We'll get you answers on any questions. To start, I'm Kmiec, part of our real estate, construction, and manufacturing group.
I'm Todd Clemens. I co-lead our manufacturing and distribution group over at SVA.
I'm McAlexander. I'm a principal in our tech service line and work primarily with manufacturers and construction.
All right, so I'll dive in. We're going to go through some individual tax items, then we'll get into some business tax items, and we'll kind of be passing the mic back and forth. But one of the things that is interesting about this bill is that it really started off as we have to do something. Congress had to do something. I recently moved from Texas to Wisconsin. The local representative was Dan Crenshaw there, and that was my House representative, represented my House of Representative. And what he said is, without the passage of this law, every American would get a tax hike. So what a lot of this was it was a prevention of tax hikes. So a first example of this would be just individual income tax rates. So we're happy to share these slides as well, but feel free to take notes or anything, ask any questions. But effectively, we were in a whole lot of different tax laws going back to pre-2017 tax laws. 2017 gave Americans a tax cut, most of that being temporary, had expiration dates. So one of the things that it did was it made these tax rates permanent that were previously there. So instead of jumping up to a tax rate of 39.6%, we stayed down at a 37%. So that's just an example. There are numerous of examples like that. Another one is a standard deduction. So standard deduction got a slight increase, but again, this was going back to old rules. Same with personal exemptions. You used to get an exemption for you, your wife, your kids, an exemption for each one. Instead, that was permanently removed. Now this larger standard deduction exists. So that's kind of where we stand. That's just TCJA provisions just made permanent.
The reason you mentioned the individual rates is a lot of our manufacturers are S corporation or pass-through entities, so a lot of the income from those corporations do flow through to the individual return on a K-1. So.
Yeah, we often tax plan the business using individual tax rates. So thanks for the clarification. Some other small things, child tax credit got a little bump up, and it will be increased for inflation each year after 26. There are, of course, phase outs, other dependent care credits. These are made permanent. Higher exemption on alternative minimum tax. So we used to see a lot of alternative minimum tax pre-2017. It got raised to a really high rate, so only affected really high income earners. And so that higher exemption, higher alt-min rates are made permanent as well. And then a big one, not necessarily tied directly to manufacturers, but owners of manufactured companies may have accumulated a significant amount of net wealth. There was a cliff coming in the estate tax world. We're going to revert back to a $6 million or $7 million exemption. But really now we're stuck with $15 million. So what this means, you can pass away tax-free as long as your balance sheet at death has net value of $15 million or less. So, and that's per individual, so married couple, $30 million.
So before this bill last year, we were talking to all our clients, and a lot of our, you've got a transfer of wealth kind of going on too, as kind of the generation goes, gets ready to kind of go to the next generation. So we were having conversations about gifting and, to the next generation. Sure.
Yeah, and it's still a good idea to do that, but we had a timeline ending in 2025, in December of 2025, that we had to get in front of because we were going to go, you could give away $15 million tax-free. We're going to go back to old rules and only give away $7 million tax-free or $7.5. So those are, that was key, very helpful for the American taxpayer, particularly the wealthy, if you consider 15 million and up wealthy. This is a summary slide, just kind of simplifies a lot of that what I just said. I want to make sure we have time for the business stuff, so I'm going to breeze through a few things. So state and local income tax deduction, you may have heard of this. It was raised from $10,000 to $40,000 as the ceiling. So you're able to deduct up to $40,000 of your state and local income taxes, or not even just income taxes, includes sales tax, includes property taxes as well. There is a phase out of the 40,000, but it will never phase out below the previous ceiling of 10,000. So you're always at least getting the 10,000, but the high income earners are going to phase out of that 40,000, reduce their state income tax deduction or SALT deduction. And then the mortgage acquisition or mortgage interest deduction, you're only able to deduct mortgage interest on a mortgages up to $750,000. If you have a mortgage over that, then you can be limited in the deductibility of that. So this was made permanent. There were some rules that was going back to the old ways. But you can also do PMI. So if anyone's paying PMI, you're able to deduct it now, which is helpful.
One thing with the state and local tax thing too, you probably saw that some of your manufacturers or your manufacturer, they were making entity level tax selections on some of the state levels so that they could deduct it on the state level from the corporate level versus pushing it over to their individual return and having limitations.
Yeah, usually when you do that, when you make that election, it's generally viewed as a good thing. Wisconsin in particular, you pay a higher state income tax rate if you do that. So if you were getting the deduction, the math worked out that it was still beneficial to make that election, deduct those state taxes at the corporate level. It may not if you have a higher cap now, so something to review and look at each year and make that election or not. A couple other things, old rules had miscellaneous itemized deduction. People use this as employee business expense or unreimbursed employee business expense or other things like paying your tax preparer to prepare your taxes. It used to be a deduction, not anymore. People still give me random things like moving expenses and other things like that, but miscellaneous itemized deductions permanently removed. There's nowhere to report those on the tax return anymore. P's limitation, another limitation that was back to pre-2019 or 2017. It is back, but there's some different differences. We'll get into what that means in a little bit, but we won't get into the details of that. It's really something that anyone's tax software is going to calculate for them. There's really not anything to do about it or plan around with it. It's just a limitation that's going to maybe limit your total itemized deductions based on your income. And then charitable, there is a 0.5 contribution base limitation as well. So there are some limitations with charity. They're not too painful. And generally speaking, what they were trying to accomplish is only saving you 35 cents on the dollar, even though you might be in a 37% tax rate. So we'll kind of get it. We have some details on that, but it really is a complex calculation that it's really the purpose of it is to provide you a 35 cents on the dollar tax savings when you make a charitable contribution instead of the 37%, which might be your marginal tax rate. And another summary slide. Here's just a general view of what the charitable contribution limitation might look like. So if you made a $100,000 charitable gift, under the new tax law, you actually might get only a $95,000 deduction on that. So the tax savings is not as great. So again, most of these tax law changes were good. This is something that actually wasn't favorable to the taxpayer.
I'll add on that if you are doing some tax planning, one thing to consider is a donor advised fund. If you think maybe make large contributions in 26, front load those in 2025. What a donor advised fund does is your vehicle to contribute cash or appreciated stock. You get a deduction in the year of contribution, so 2025, and then you can make those distributions to the charitable organizations, and 2026 or 7 whenever you choose.
Yeah, that's a good point. If you're considering or you're looking at, you can afford to make a 5-year contribution. You can do that into a donor advised fund. Take the bigger deduction in 2025 because those new charitable rules don't go into effect until 26. So take that in now. Get the better tax savings now. Just a way to help save a few bucks. A positive thing for charitable contributions, there's now an above the line deduction, so you don't have to itemize to get this. $2,000 for married filing jointly, $1,000 for single filers. something that's going to save most people would likely give at least $1,000 to $2,000 charity every year. This is going to help every taxpayer. This, however, would not include a donor advised fund contribution. Generally speaking, this is stuff that you're doing to your church, your local Boy Scouts, whatever it might be. Good old wagering losses. So gambling losses used to be deductible only to the extent of winnings. Now it's only to the extent of 90% of your winnings. You will pay tax on those gambling winnings, even if you may have lost more in the year, just because of this limitation. I have an interesting story here, maybe lighten the mood up a little bit, but I had a client that won the lottery. He got the 20-year payout. So he was able to effectively, he was getting a very large W-2G every year. I think it was a little over $3 million every year he was getting. So this was coming in a check every year. He took all of his casino losses. He enjoyed going to the casino. He calculated them, saved all his receipts, and gave it. So he was able to take a big gambling loss every year based on his fun that he was having at the casino, because he had W-2G winnings from that lottery winning that happened 20 years ago. So just a funny story, but something now that he would only be able to deduct 90%, or he would probably deduct all of it because it's to the extent of 90% of winnings. So it doesn't necessarily change for him, but it might change for the, average casino goer. Okay, this is a new one. It is, we put it under our individual section because it is an individual deduction. So you may have heard no tax on overtime, no tax on tips. It's definitely a campaign promise. First of all, tips and overtime pay will be taxable on Social Security and Medicare. So you're still going to pay Social Security and Medicare taxes on that income. The way they pass this through budget reconciliation process, you couldn't actually change that specific Medicare Social Security tax coming in on that type of income. But it is interesting how this will work. But effectively, you're going to get a deduction, a personal deduction, for your tip income or your overtime pay. For the employers out there, this will also mean you're going to have to report that to your employees on the W-2. From what we're hearing, the W-2s for 2025, those forms are set. There is no code for tip pay, overtime pay. So you may be able to provide your employees information so they can better do their taxes. But to me, I've heard it described as the Wild West when it comes to what income is going to be eligible for this deduction. So I think I have another slide on this. So deducts for overtime pay and tip are the same. So up to $25,000 for a joint filer. Both are available as a personal deduction and subject to phase out. So high income earners are not going to get benefit of this. On the tip income, you do have to look at, has to be a normal business that receives tip income. So us accountants out there, we couldn't reduce our fees, ask for a tip at the end of our service providing. That's not normally an occupation that exists in. So it is limited to things like that. The overtime pay is good. There's a section up here called the premium portion. You can see that. So if you're paying time and a half for overtime pay, you would think all that's overtime pay is subject to this tax. No, it's just a half. So just that premium piece is going to be subject to this deduction. And it is defined under Fair Labor Standards Act. So, a union might classify a 9-hour day as 1 hour overtime and 8 hours of normal pay. But FMLA does not do that, or Fair Labor Standards Act does not do that. It has to be over 40 hours a week. So even your system, the way it's set up, may not actually be subject to this. So 2025, you probably don't have to worry about that when you're doing your W-2s in early 2026. But as things progress, there'll be a section of this that you'll want to get in. The other thing it is temporary. On the overtime, so if you are considering changing for the benefit of your employees from a salary to hourly, this does go away after 2028. Maybe it gets extended, maybe not, we'll see. But it is something to note if you are thinking about changing and helping your employees a little bit, that it is subject to going away. So this is the campaign promise fulfillment, but as you may see or may notice in the details of this, it may not be getting the benefit of everything. And it certainly has a limit to how much the max benefit is. But effectively it comes in as a deduction. So you're reporting your gross income to getting a deduction for those. Any questions? I've gotten a lot of questions over tip and overtime. So W-2s got harder. It's going to take more paperwork. It's going to take your payroll people a little bit more time. Good news on the other side, 1099 reporting got easier. So you only have to report 1099s that are over the threshold of $20,000 or 200 transactions. So those are a little bit easier. So growing the range, you don't have to send as many 1099s. 1099 should be a lot less this year. I think this might help the IRS out more than the taxpayers, but. Any employers in the room, the ERC calls from the providers will finally stop. So a lot of you may have gotten solicitations over the years of, hey, you qualify for this ERTC credit. Basically, if you filed for an amended report or anything after 1/31/2024, the IRS will send, if they have not already sent, a denial of claim letter. So you're no longer, if you filed after that date, you're not eligible. It also put definitions for ERTC promoters and increases penalties on them. So if you used a service like ERTC.com, or if you heard an ad on the radio and followed through with an ERC credit with them, they might be deemed and defined as a promoter. The IRS is actively chasing them. They likely want their client list, see who was eligible, who they said was eligible, and then in fact they may not have been. So a lot of fraud occurred in this area, but it also points to they extended the statute of limitations. So if there are any attorneys in the room, watch out for that on deals. You're going to have to maintain ERC questionnaires and make sure those will document it through any deals. But those are statute of limitation extended. Allows them to the IRS has more time now to come and chase any ERC fraud that happened in that world. Okay, I think this is the last one on the individual side, Trump accounts. So for kids born between 25 and 28, I've got one of those. They're going to get $1,000 funded into an account for them next year if I don't set one up for them. So this is actually eligible to start in 2026. I imagine at some point in the spring next year, you're going to hear about banks providing Trump accounts for their clients. But effectively what this does, it works a whole lot like a Roth IRA. So tax-free growth, as long as you take the money out for specific uses. Parents can contribute to it. Grandparents contribute it. Even employers can contribute to it. But generally speaking, you're using after-tax dollars. The employer one, if you do it, it gets a little bit tedious and detailed in how it works. But you can do that with pre-tax dollars. But then you've got to track those pre-tax dollars in the Trump account, and hopefully the banks will take care of that stuff for you. But just another option to help kids out there establish savings, grow a little bit of wealth. You can either it'll fund. I think did I have this section up here? I don't think I have a slide that says what they're used for. Maybe this next one. Oh, so you can use them for medical and disability. You can use them for education or first-time home buyers. Yeah.
What is that? Go back to the slide. What was that last Treasury will open accounts? What is that?
Yeah, the government will open an account for the child and put $1,000 in it if you were born between 25 and 28. So they will establish it and do it. critics of this said that's going to be a bunch of wasted money because no one's going to know how to find it and get it and access it and take the money out if they want it right away. So, but they will fund it. They are funding it no matter if someone sets up an account or not. So if you set up an account through a financial institution, which you're not actually allowed to do until 26, they will fund that account. But if you don't do one, then they will just create an account. I don't know what it'll look like or how it'll look, but they'll create an account and set it up for you. Thank you. Yeah, so you can use for education, home, medical, disability, family, and legal. You can also use it to pay off your kids' tax levies. So that's fun to say. But again, interesting. It works like the best thing to do is, in my mind, is just compare it to something that most people do understand. It works like a Roth. So it works like a Roth. You get tax-free growth. People know that's a good investment, and then you can use it for anything, or you just can save it. So. Okay, that's it for me. I think Todd's gonna take over on business stuff.
Anybody have any questions for what Kyle presented? This was a big, long presentation that we've kind of streamlined down to kind of hit some of the things that kind of hit manufacturers or businesses and kind of how things flow through the individual level as well. So from the business side, 100% bonus depreciation. I don't know, we've got a lot of clients as we do our tax planning with them, and we're working with them trying to reduce income. And one of the ways and one of the benefits that's out there, tools that we have, is bonus depreciation. So what bonus depreciation will do is it'll allow you to write off your fixed asset purchases. So if you want to kind of bring down your taxable income at the end of the year and you're looking to buy some equipment, you can purchase that equipment and take an immediate 100% write-off of that equipment against your taxable income and reduce your tax liability. So similar to 179, but in terms of Section 179, you do get the immediate write-off, but there are limitations on the 179. It does phase out at certain levels as well. And for the bonus depreciation on 179, it could be new or used equipment, both, that you could use. So, again, a tool that many of our manufacturers kind of look forward at the end of the year and say, okay, hey, I want to bring my income down, and I'm going to buy this piece of equipment or buy a few pieces of equipment and take advantage of it. And one thing too, I see a lot of bankers in the room too, so you can kind of reference that out to your clients too if you're looking for loans or so forth. Business interest expense limitations. So there is a limitation on interest expense that can be deducted on your business return, limited to 30% of income. In the past, from 22 to 24, when they were calculating that income, it was not including depreciation and amortization for an add back, but for that limitation, with the big beautiful bill, now you can add depreciation and amortization back to that base of your income for that 30% calculation. So in order to take the interest expense, you do have to have enough income to hit the 30% threshold, otherwise you start losing some of that.
Speak up a little bit. Thank you.
Yeah, well, you see this on heavily leveraged businesses, private equity type owned businesses. Interest expense often gets limited on those because you're using this calculation of effectively EBITDA, and then you're only able to deduct 30% of EBITDA as interest expense. So it previously was EBITDA, now it's EBIT, so you get that depreciation and amortization in there.
Better now with this? Sorry about that. John did warn me, but I thought I could talk loud enough to make it work. But any questions so far on these two items? Excess business loss deduction. Now they made this permanent. So what this is losses that kind of you generate from your business entity and it passes through to your individual return or to a trust or an estate. There is a limitation on the amount of that deduction or those losses that you can take. It can't just wipe away all your wages, all your investment income and so forth. So, it could offset other business income that you have if you have a loss from a pass-through entity that flows through. And then there's our limitations on the losses depending on married or individual status.
Yeah, what they did on this is previously, when you encountered an excess business loss, it converted to the next year as an NOL, which you may actually have the ability to then offset your interest dividend type income with. Now it just maintains EBL attributes, tax attributes. So it carries forward in a different way, but they also made it permanent. These were set to go away, and now they're here to stay. You got a question?
Question on the bonus depreciation. Are we going to go back to the schedule for 26 and 27, or does it stay elevated going forward?
It's permanent. 100% bonus is permanent now. It'll take an act of Congress to change. So that's a nice bit of certainty, because many, many years as a tax practitioner, we ran into situations where, well, we think it's going to be extended, but we don't know. You know, it's 50%, but we don't know. Right now, we've got 100% bonus and permanently in place. Would not get good press to make that go away. That encourages M&A in the marketplace. That encourages CapEx, investment into your own company. Those are good things in general for society to do, for corporations to do. Helps create jobs, all those things, right? So to take that away or to put 50% bonus in place, it should get negative press.
The only caveat on the bonus is you have to watch the state treatment of that. So some states will not adopt the bonus thing. Wisconsin is one of those, but Wisconsin typically will kind of mirror the Section 179 deduction for federal too. So a lot of times, if you're a business owner, you may have multiple tax schedules. You have a federal schedule, you have a state schedule, you'll have
one for your books,
and so forth. So again, just keep in mind that's the only difference with the bonus and the 179 as well, that there may be limitations based on the state deductibility. Turned over to Reach.
I'm gonna grab the one over here. All right, everyone's favorite topic, research and development expenses. So probably you've all had lots of conversations about whether R&D is going to continue to be capitalized or deducted over the last few years. Now we know for sure what's going to happen with it. As a recap, because of the Tax Jobs and Cuts and Jobs Act, starting in 2022, those R&D expenses or Section 174 expenses were required to be capitalized over 5 years. So this really caused some cash flow issues for a lot of businesses that are heavy in R&D because they could not deduct all of those expenses in the year incurred. We went from being able to deduct all of them to 10% in year one and the rest over the remaining 4.5 years. So now, effective as of 2025, we can go ahead and expense all of those expenses in year one. And so what do we do with those undeducted capitalized expense from 2022 through 2024? Well, we have a few options. One, if it's a business that's considered a small business with 31 million in receipts or less, they can go back to 2022 and 4 and amend those tax returns and get refunds from those expenses in those years. Or they can choose to move forward. And if they're not qualified small business, these are the options that they have. So you can deduct all of those undeducted expenses in 2025. You can spread them over 2025 or 2026, or you can just let that capitalization period run out. Things to consider here is what tax bracket was the taxpayer in that year. If you're in the highest tax bracket every year and you're going to be able to deduct those remaining expenses at the highest tax bracket, it's probably best to take it in 2025 and be done with it. However, if there's fluctuations, you want to be careful because these are valuable deductions that you want to be able to take at the highest tax rates. You've got to consider what year that will be in. Side note, any foreign R&D that's still required to be capitalized over 15 years.
This was a big win on the Big Beautiful Bill for manufacturers because, as Rachel said, in the last couple of years, you've had to take all your R&D, and every manufacturer has R&D, and you had to basically capitalize it for tax purposes, deduct it per book, capitalize it for tax, pay the taxes on it, amortize it over a 5-year period. And the last couple of years, there's been bipartisan support to repeal it, but I think they just couldn't get both parties to put something together and do it. Well, this is it.
It was always coupled with something that couldn't get passed.
Exactly.
So-
There's always something that gets added to it.
Yeah, we've talked about this a lot. So does anybody have any questions? This has been a pretty big topic.
Yeah, if you don't know what R&D credits are, expenses are, you want to go back to that 4-part test? Basically, it's a type of expense that meets these 4 tests. And generally speaking, what we see the most expenses are is wages. So wages of activity of employees performing these type of activities. So if they're in the experimentation process or developing a new product, or even just sometimes testing a new product, if you're reorganizing your manufacturing facility, trying to make it more efficient, testing and going through a scientific process, those employees you're paying wage to twice a month. Their costs are suddenly not deductible. They're capitalized and amortized over a 5-year period, and really that's over 6 tax years. So it was very painful for taxpayers to do this. I had several taxpayers that, relative to their book income, are paying 60-70% tax rates because so much of their activities were performing R&D functions. Had clients out there that said, if we follow this tax law, we will go bankrupt. And that's how bad it was. And it was really designed and put in place in 2017 with like a delayed impact. They passed the law in 2017, didn't start until 2022. Then it led to we'll fix this problem before it gets here in 22. They never fixed it. And so 22, 23, and even 24 all had to deal with paying in tax on expenses that they had to capitalize, paying their own employees. So it was very painful. And it also wasn't something generally if you're making a big CapEx expenditure, you're getting the bank, so your cash flow is paying the bank over time, you're getting the deduction over time. So you couldn't finance your W-2 wages though. You can't go to a bank and finance that. So you couldn't finance your R&D activities, but yet it created this tax asset on the balance sheet, which was very, very painful for clients to deal with. So.
This also caused businesses to not go after that R&D credit as aggressively or at all. So I think we're probably going to see a lot more people go after R&D a little more aggressively. And if somebody doesn't know if they have R&D, a good rule of thumb is if you have an engineer on staff, you have R&D. Okay, so moving on to qualified business income deduction. That's that 20% of profit deduction that came as a result of TCJA, subject to some limitations. That has now been made permanent with some expansion to the phase-out ranges. So no big change that people will see this year.
The other thing on QBI, or the pass-through deduction, basically they created this phantom deduction for taxpayers that are structured as pass-through businesses. So if you have a partnership, an S-Corp, or a Schedule C pass-through, the TCJA gave a big tax cut for corporations. So they went from 35%, 37% top tax, or 35% top tax rate to 21%. In order to give the individuals that had pass-through businesses similar tax cut, they gave a QBI deduction. So it lowers the overall effective tax rate of the business that is paid by the individual. So that was the purpose of that. It helps me understand it a little bit better. What's the purpose of a phantom deduction? They didn't want to give the CEOs of the world that are making $20 million a year a tax rate cut similar to corporations. So they only gave it to the small business out there. There's a ton of small business S-Corps partnerships, many more than those than C-Corps. So that's why they put this deduction in there, to give them really an even playing field, or a more even playing field.
Without this, we would have seen many businesses convert to C-Corp.
Correct.
Todd touched on this a little bit. We have enhanced section 179. So section 179, you can take on new or used equipment or assets that you have acquired during the year. The threshold has been increased to 2.5 million with face out threshold at 4 million. And this also applies to some real estate expenses, such as leasehold improvements. If you're making improvements to the internal part of your building that are not structural, you could take section 179 and deduct all of those expenses in year one. We also have some restaurant property, some expansion there, and also some retail property. So a little different than bonuses, as Todd was saying. You cannot create a loss with section 179. So got to kind of decide which is better, bonus or 179.
And the state treatment, as I've talked about too.
Mm-hmm.
So Wisconsin will recommend, typically it will mirror the federal laws for the 179, but for the bonus, they typically won't recognize it. Wisconsin at least.
So back to bonus depreciation. A new thing here is that we have qualified production property. So if a manufacturer is considering building a new building for manufacturing or production purposes, this is a really big deal because they can now deduct 100% of the cost of that new building in year one, starting in 2026. So it has to be new construction, or if it's not new construction and they purchase a building, that could work too, depending on when they purchase it, as long as that building has never been used for manufacturing and never been used by that taxpayer. It's important to note that this excludes any part of the building for office work, sales, R&D, and some other things. So maybe not 100% of the building is deductible in year one, but a lot of it. And this is, compare this to if you don't have this 100% bonus provision, the building is depreciated and deducted over 39 years. So it's quite a big difference. You really want to think long-term with this strategy. If you don't continue those manufacturing production activities in the building for at least 10 years, there's a pretty hefty recapture that will have to be recognized as income.
Yeah, if you happen to be weighing whether or not to renew your lease, maybe buy some land and build a building, this is definitely a factor to be considered. It's also part of just a general, from a macroeconomics, bringing in, foreign manufacturers, build in the U.S. Guess what? You get the new bonus depreciation deduction that you're allowed to basically deduct the building. So, very surprised to see this, but we, as tax practitioners, you also look at cost segregation. So we separate the real property, the 39-year assets, into a bunch of smaller properties, 7 years, 5 years, 15-year type property, as a way to get that down. But now with 39-year being able to be fully bonus eligible, as long as it's not part of your parking lot or office space in that building, but as long as it's just a manufacturing facility, that's a big deduction available, and can really weigh that, should I lease some property or not. The other thing I've heard on this is, I'd say 95+% of the time when small businesses create, build a building or build a lot for their own facility to operate out of, they set it up in a different entity and rent. So if you do that, we're hoping that they clarify with some IRS regulations, but right now that's generally a rental activity property, not necessarily a manufacturing production property. So you may actually lose the benefit if you separate and do it in a separate entity. So it's something to consider, and I'm hoping they clarify and give us some better regulations on that. But right now it may be, you may not get the benefit even though you just set that up to separate it for legal purposes, liability, risk management purpose. So
yeah, as it is now, you have to set that up within your operating entity. So if it is a new building, you might want to consider, is this a new business also, and probably use a partnership structure.
Yep. And that's available till when? Sorry.
2020, it's 9, I believe, is when the construction has to start and then completed by 2031.
Yeah, there's the dates. They're there. So it is just a limited time and this is available. So maybe it gets renewed and extended, but right now you do kind of have to act soon because it does have an expiration date on it.
I have a question.
Go ahead.
If an investor buys a property and the entity leasing has to expand, I have a friend who's looking at doing this, do they get to write that off, or does it have to be the manufacturing company who owns the building?
Should be the manufacturing company. We're hoping for the self-rental, all one ownership group that you can still get the benefit of it. But I think in your situation, I don't think so.
Any other questions?
So on that 100% depreciation, do they have to decide to take it all at once
Yes.
in the year that they do it, or can they look at their earnings and say, hey, I want 250 of it this year?
Yeah, it is bonus depreciation, so generally you can elect out of that, but you have to elect out of it on the entire class life. So all your 39-year property then goes away. So you couldn't do just a piece of it. But this would take your income below zero. Other loss limitation rules would come in and carry forward those losses to future periods, especially with a big building. That's going to offset all your income and more. You're going to create a loss. It's not going to be lost. It's going to be carried forward to be benefited later.
All right, so not a whole lot changed with business meals. They're still at 50% deduction. There was a little expansion for the fishing industry. And entertainment still is non-deductible. Qualified small business stock exclusion. So this one's been around for a while. It allows you to exclude gain if you've sold qualified stock that is from a C corporation, a domestic C corporation, originally issued with assets less than 50 million at the time of issuance. And of course, it needs to be engaged in a trade or business. Now, with the reconciliation bill, they've increased the assets to 75 million. So now larger corporations can take advantage of this benefit. There is a holding period requirement. You've got to hold this stock for at least 5 years. Under the old rules, you get 100% exclusion if you hold for 5 years, as long as you purchase that stock after September 2010. If you purchased it before that, you get either 50 or 75, depending on when you purchased it. Now, as long as the stock was purchased after July 4th, 2025, if you hold it for 3 years, you get partial exclusion, 50% for 75, and then a full 100 at year 5. So this really opens it up. If you have a business that you're going to sell relatively quickly, you can still count on that exclusion of gain at year 3, at least in part. There is a cap on how much can be excluded from income. Previously, that was 10 million or 10 times the taxpayer's basis. Now that's been bumped up to 15 million or 10 times the basis. Again, that's for new stock issued after July 4th. And it's important to note that exchanges and rollovers don't qualify. It really has to be that original issuance. Qualified opportunity zones. This one, if you are selling any real estate that you use for investment or business, you can defer the gain that you get on that sale if you contribute those funds to a qualified opportunity fund. So if you do that, you can defer the gain under old rules until you either sell the investment or until December 31, 2026. Additionally, you get a step up in basis or kind of a permanent exclusion of gain for 10% if you hold the fund for 5 years, and you get an additional 5% after 7 years. Under the new set of rules, that capital gain deferral will last for 5 years or until you sell the investment. You still get that 10% basis step up, but that 5% at 7 years is gone. And there's also a new class of investments in rural areas, so areas that have 50,000 or more people. You can get a 30% basis step up after 5 years. So they're really starting to focus on those rural areas with this. There's an additional benefit if you hold that fund for at least 10 years. Under the old rules, any appreciation would be tax-free upon sale. Under the new rules, that still applies, except if you hold the fund for more than 30 years, anything after that 30-year mark is taxable. So sell before 30 years. Another opportunity in regards to real estate and investment is the new markets credit. That's 39% of qualified equity investment over 7 years. That's if you invest in low income census tracts. That's real estate, community facilities, operating businesses. Under the new rules, that credit is unchanged in terms of value. However, some of the eligibility areas are a little different. We expect alignment with opportunity zones and preference given to rural areas, rural mixed-use projects. Both the opportunity zones and the new market credit, they're made permanent now, so investors have some certainty when they're making their plans. The new market credit was one that was temporary, regularly renewed by Congress, so now it's permanent, and we can count on that. One thing to note on the opportunity zones, if you're taking advantage of that investment, it's really important that you're working with the right professionals. There's significantly more reporting requirements and significant penalties if you're not following the right rules with that. So make sure you're talking to someone who really knows what they're doing there. Anything to add on that? We didn't really talk about international tax too much, but if you have foreign holdings, you could see higher effective tax rates with the reduction of some expenses. All right, pass-through entity tax. Todd, you hit on this a little bit earlier. This was a strategy that states created to allow taxpayers to deduct all of their business tax, pay the business entity tax on the entity level, and thus were able to deduct that full amount of state tax on your federal tax return. Now with the SALT limitation going up to 40,000, we don't see as much of a benefit for some people. It really depends on your facts and circumstances, but that's something that you'll want to monitor and make sure that that's not costing you more taxes than it's saving you. There are some states that ended this provision as of the end of 2025 that will need to extend it for it to be available again. So if you are a multi-state taxpayer, you'll want to be looking out for that. State conformity. This is the 4 big ones we're really following right now to make sure that states are either following them or not. We know how they're going to handle them. R&D, business interest expense, bonus depreciation, and some international tax provisions. Some states have rolling conformity with the Internal Revenue Code, so they don't have to do anything additional to adopt those federal rules. Others, however, have to pass some legislation to conform to those rules. And unfortunately, we don't know if they're all going to have that done by March 15. So just a heads up, if you are a multi-state taxpayer, you might need to extend your return to see where these rules are going to land for these states. The pass-through entity tax strategy still could be beneficial if you are a high income earner with over 500,000 in net income, have a profitable pass-through entity business, and it helps if you have minimal itemized deductions outside of SALT. Any questions on that before I pass it over to Todd? All right, someone tell us about energy provisions.
I will make this quick because I want to leave a little time for questions and so forth. So basically, with the energy provisions, it kind of rolled back a lot of the deductions for energy improvements. So, electric vehicles, if you bought it before September 30th, 2025, you got your $7,500 deduction if it was purchased new, $4,000 if it was purchased used. So those deductions were kind of rolled back into the bill. Some of the home clean energy credits, energy efficient commercial buildings deductions, those were out there, but they are limiting those and they do phase out. So the energy efficient thing is done after June 30th of 2026. Same thing with the home credit, that's December 31st, 2025, and the clean energy credit. So Republicans in the bill are kind of rolling back a lot of those clean energy initiatives that were out there before. So long story short, if you want to take advantage of the credits, your time is running out. As I mentioned, with the clean vehicle credits, the home credits, and so forth from there. Go past this. So again, just to review the timelines as we were talking about for the deductions to take advantage of them.
If you have a solar project or any energy project, you'll want to make sure that that project is going to be completed. You have authorization from the utility company to connect by December 31st, or else technically it's going to be really hard for you to prove that you can get that credit. So make sure you're on your contractor to get those projects done.
Like I said, I rolled through that very quick, so I wanted to leave some time for questions. So I don't know if anybody had any questions. I know there were a few that came up as we were going through the presentation, but please feel free if we didn't answer any questions you had, or if anything we presented kind of added additional questions that you had or created some confusion. I mean, this is just a portion of the bill. Normally this presentation is a lot longer, and we've just kind of, like I said, brought it down to kind of conform to what maybe would affect manufacturing and the individual owners of manufacturing facilities. A lot of stuff that was kind of thrown in there. Got to be some questions out there.
So you're going to share the slideshow?
Yes, we can share the slideshow.
Go about getting.
We can send it to you directly if you want to just leave your contact info, but if possible, I don't know if there's an app or anything with the conference, but we could upload it to that, so we could share it to anyone.
Yeah, if you leave a card, we'll start there, and then
we can share it with you directly. It'll be no problem.
And then we'll talk to BizTimes too to see what option it might be to get it out there. Like Kyle said, if there's a site to download it out there.
This covers probably 70%, 75% of the tax changes that occurred. There's obviously a lot of other things in that bill that weren't even tax related, but this just hopefully give you some answers on tax things. And there were some good benefits in there, particularly around bonus depreciation, R&D. Those are major tax implications for certain clients, and we were definitely happy to have it.
All right, at that, I'll call it an end. So if you have any questions, feel free to reach out to any of us. Our contact information was up there, and thank you.